very large sort of high volume injection into the market, where underneath the low or above the high in which the order was injected, it's going to store a lot of liquidity. And the next characteristic to one of these zones would be it has no immediate liquidity, or as we call it, inducement. So what does this actually mean? Let's have a look. Let's draw a little diagram. So the market creating a order block, a very high volume move in the market, in which we contain no liquidity inside of the leg, and it's a very sort of high volume move. So price is not sort of inclined to hold a level like this, since there's no liquidity to actually take to continue using, to use and mitigate this level to push up. However, for price to sort of be able to fuel the move up, we're likely going to want to take liquidity, and since underneath a smart money trap, an area with large volume is going to contain lots of orders underneath this low, price is going to be contained to liquidate, to use it to continue up. Why do smart money traders like using these zones? Well, smart money trading teaches that high volume sort of S&P or high volume order blocks, or the order blocks which have the intention to cause a break of structure, are the sort of highest probability ones to look at. However, we understand the market works on liquidity rather than supply and demand. There's three different entities in the market. There's buyers, there's sellers, and then there's the algorithm, who's buying and selling everything at the same time, and perfectly manipulating price in a certain way to emotionally and technically manipulate traders to get involved into the market, build liquidity on both sides to then manipulate one side and trade towards the other to reach higher time frame desirable levels, all a part of the lower time frame and higher time frame liquidity cycle, which is fractal in nature, as we have described. So one thing you could expect is when price does reach a level like this, you could see a fake reaction, which is just to try and induce more traders to get involved off of lower time frame confirmation levels, and then it will liquidate and continue. Take a look at the chart. They're extremely easy to identify. Got a couple here. We have a very large push, very high injection of liquidity, and obviously the small money trap is a fractal sort of characteristic of the market by nature. So no matter the time frame when these sort of levels play, they are respectable on each time frame. It's a fractal sort of concept. So we can see this push up, which leaves behind this order block here. So very high volume, and also contains no immediate liquidity. No liquidity inside of here. So we could expect this zone to not hold. And subsequently, as price does push down, what happens to price? Price comes to mitigate this level here to clear a range of internal liquidity. This low is strong, since it sweeps strong liquidity. We have a rejection candle, which confirms this as a sweep. No body close, just a wick rejecting the level. Price comes and trades into this level and continues to move off, giving potential buy opportunities. And as price originally pushed down here, we can see it left behind another trap. This trap level wide because inside of here, this push, we have no liquidity, and it's very high volume. We know above this high is going to store a lot of liquidity. So the price is going to use this as its next target. So you can carefully see how the algorithm manipulates the market, allowing traders to sort of want to get involved early, getting swept out, come to mitigate the correct levels, moving away, and as so building its future liquidity points, continue up and liquidate, and allow price to continue moving. Why does a level like this hold? Well, we can see that this level here, this particular level, has immediate inducement. Takes strong liquidity and mitigates. It's a strong high which grabs liquidity, also known as an algo candle, which we're going to talk about shortly, in which price comes in the form of lower time frame inch confirmation, where you could be involved as a seller inside of here. Price continues down to come and take out internal range liquidity, as we discussed earlier. Once again, why is this specific order block an interested point for the algorithm to deliver to use to propagate and move price in its desired direction, which is a part of the liquidity cycle? Because notice how this mitigation here also builds up higher time frame equal highs. So now price can trade back down into a more desired pricing level, allowing both sellers and buyers to get involved at a more fair price. Why is the market more fair priced? Because this is our price range. We've now traded back down into the equilibrium point. This is our high, this is our low, this is our 50%. Our 50% is where supply and demand are both equal. Both buyers in the market are happy to buy and sellers are both happy to sell at the same time. So significant liquidity gets generated when both sides of the transaction are happy to enter. Both buyers are happy and sellers are happy. That's when significant liquidity is generated. Price delivers to this specific level. Since this level has immediate liquidity, which gets swept, come to mitigate here. Price pushes up from there, coming to clear out higher time frame liquidity point, which was the equal highs. And continue playing. Even on a more fractal level here, we have a zone with high volume. Okay, I'm just checking I was actually recording. A zone with high volume, what we'd call a vector candle. No inducement stored within this pricing push. The algorithm is not inclined to come in to mitigate any of this to continue up, since there's no liquidity to harvest. For our next push, say the algorithm was wanting to come push up to clear higher time frame liquidity here. Well, if the algorithm wants to push this level, how does it get there? It needs to take liquidity to be able to get there. It's not going to react off this level because this level has no liquidity to take. So obviously it inclines traders to get involved off of this mitigation, which eventually fails. We can see how this level now gets swept and liquidated, and it could potentially be used by their algorithm to continue up, etc. Depends on higher time frame market conditions. Where does the market actually want to go? Cool. Let's have a look. So we're still keeping an eye on our liquidity point. Higher time frame liquidity. Our internal range liquidity gets cleared. Have a full clear of all internal liquidity, leaving behind a smart money trap again, which gets liquidated. Then we finally have price deliver to this higher time frame level, clears liquidity, and as it clears liquidity, leaves behind a trap, which can be used as a target point for the algorithm to deliver to in future time. So once we deliver to this higher time frame level off of this higher time frame, a daily sweep of liquidity, price wants to mitigate this daily sweep of liquidity and continue to reverse to harvest more liquidity on the other side. We've taken out a significant amount of sellers in the market above this daily high. So in response to this, the algorithm is going to use that as fuel to now come and attack the buyers. So price sells off of this level to come attack buyer liquidity in the form of this smart money trap and the smart money trap we spoke about earlier, which gets completely liquidated. and price can deliver it to its next sort of desired liquidity level. You can clearly see the market building liquidity on both sides of the market. It will liquidate one side. Side's been fully cleared, and we will keep all of this liquidity remained to take out on our next sort of liquidity cycle push. You can see more smart money traps being developed, being used as fuel. This level getting trapped here, being used to create a pullback, likely for price to come into a more well-priced level. Sweeping liquidity, may want to continue down, use this level. There we go, so this level plays because it has inducement. We get a mitigation here, which clears inducement. This is just going back to the algo structure, which we spoke about earlier, which price may want to feed into, continue pushing the market. It's how you can get involved in these sell positions within these high time frame levels, or lower time frame, more intraday levels, along the high time frame liquidity narrative. Look at this. This liquidity gets cleared perfectly for price to continue. So, we've sort of discussed smart money traps in this sense. We've seen quite a few plays in the market. Spoke a little bit about liquidity here. How the market is just generally moving day to day based off of its liquidity. Nothing too crazy. Smart money traps are essentially very easy. Just remember the quote: if you can't see the liquidity, you are the liquidity. And think about the nature of the market. The areas with the most liquidity stored are going to be the most obvious and bait. So that's why you have to play it smart. Allow manipulation to happen before your entry, and then you can allow yourself to get in at a more well-priced, higher probability area to ride the market to its desired direction. So now we've discussed smart money traps. I'm going to touch on market maker models. Essentially, we've discussed throughout this call already the essence of how the algorithm builds liquidity on both sides of the market, liquidates one, and continues to trade to the other. So what we want the market to do, creates the easiest conditions to sort of trade. What am I even doing? What am I looking for? Path. The most common form of a market maker model is a range, a consolidation in which both sellers are happy to get involved and also buyers are happy to get involved as well, off of levels, demand levels, and we've got sellers getting involved off of supply levels, support and resistance. Both market participants are interested in getting involved, high amounts of orders and liquidity being created. Price will liquidate one, usually very aggressively. Why does the market manipulate aggressively? This is something you need to take note of. Just think about it. The market wants to manipulate aggressively to allow zero time and zero latency for you to make a decision. It wants to punish. It's all an emotional mind game. The reason the algorithm exists is because 99% of the market are human traders. Human traders have emotion, which differs from an algorithm, a robot, AI, program. Humans have emotion, and emotion allows room for error and mistakes. So, the algorithm manipulates quickly, so you don't have time to consider your decisions. Before you know it, you're out. Maximum emotional damage. Once liquidity is taken, it will reverse straight back down to harvest the rest of the liquidity. Why is this the most effective way to do so? Because as price breaks out, since we've just ranged, now we've had a breakout, traders are like, we've broke out of this range bullish. That is signifying the strength of the market after both buyers and sellers battling, creating a stagnant price movement. Both buyers and sellers not sure who's in control. As it breaks out, traders are convinced that buyers are in control. and they may be looking to get involved in buy opportunities, which eventually fail, and the market comes down to clear this side of the liquidity too. So both parties get manipulated at once. So market maker buy to sell model is, of course, when the market ranges, it will buy to then sell. So it buys up, leaves behind a trap, and then sells down. And obviously then you've got the market maker sell to buy model. Oh shit. Market maker sell to buy model, which is obviously price selling, selling off, leaving behind a trap, and then continuing up. Both parties being taken out. It's a pretty common model. It's essentially the most effective way for the market to generate liquidity in range format. Usually if price is just pushing up, traders are scared to buy because they don't want to be too late buying, but they're also too scared to sell because the market is just too bullish. It would feel unnatural to take a sell in such a bullish market, whereas a range, lower volume trading, where we have this rangey price action, price unsure, traders are both inclined to sell and buy at the same, sell and buy. It depends on who they are, what they're thinking. It's a highly formidable way to generate liquidity for the market to then be able to harvest and continue in its direction. So it's a little bit of a discussion around the market maker models. Next on the agenda, we have fake breaks of structure and fake changes of character. I'm going to talk about the vector candle too and news. I'm just going to quickly touch on the vector candle. Essentially what a vector candle is. Vector has displacement and magnitude from the physics definition. A vector candle is essentially a price movement of high volume which moves the market, or it has high displacement. So essentially just like how we're looking at our smart money traps, we have these high volume pushes in the market. This sort of push up we can describe as a vector candle movement. I'm going to quickly pull up a little example from my data collection actually, which I was doing prior to recording this. Just going to pull it up. This is just data on winning trades. For example, this here. Can I pull up paint? Cool. This example here, this green box here, we'd call a vector candle. As you can see, the market has built liquidity on both sides of the market, creating this range. Typically, after we have slow, rangy price action, we're going to get some large injection of capital. Most of the time, going to be a vector candle. Why? Because obviously, vector candles leave behind smart money traps. So I can understand that this price range here, this whole buy to sell, I can't draw a straight line. This whole sell to buy range here, causing this push up, likely going to fail. We know there's a lot of liquidity stored under here. But another important thing to know about the vector candle, this is touching on mitigation slightly, but an aggressive move into an area. So an aggressive move in, say a high time frame level, which we can see by this line up here. Trust me, there is a high time frame level. A high time, I think I've actually got another markup on there. Okay, there you go. So this is the high time frame level. You can see it's internal range liquidity. We've had this whole range of price action here. This whole range of price here. This smart money trap here. This whole range of price gets liquidated with a vector candle. And the key thing to know about a vector candle is An aggressive push into a level usually is going to signify an aggressive push out of a level. So when price hits this large vector candle sort of movement into your area, it's likely going to signify a large movement out of your area to come and take this low out as future liquidity. Another thing to know about the smart money trap too, it's also more effective when it takes liquidity. So say for example, let's get pen and paper out, have a little drawing. So when price has this large push up, we identify as even behind a trap. So if price pulls back to this level, say you're looking for sells in an example like this. Over here we have some sort of higher time frame liquidity. Maybe it's like some nice inducement, like so. We're like, right, we're looking for a sell here. Price pushes up with a nice vector candle, so an aggressive move in. We're expecting this aggressive move to probably come out of this zone, since once the market is pushing buys so heavily, retail traders are incentivized that the market is going to push. Higher time frame traders who see this as a 4-hour breakout candle, 4-hour large bullish candle, could be setting buy orders like this with large stop losses. However, this is simply a fake push in the market, a fake buy order. Gives an aggressive push back down again. A fake buy up. This vector candle is a fake push, showing fake momentum, fake demand in the market, to then continue down. So we hop back on here, we can see this aggressive move in, then we get these extremely aggressive candles out, come to deliver to our sell side liquidity target, which was this swing low, happened to also be beautiful equal lows. We know there's lots of liquidity stored here. When you actually, let's zoom out a little bit. When we look at this push here, we leave behind this zone. It's a trap because there's no liquidity. So price absolutely melts through and comes to hit our higher time frame level, which we could expect to see buys out of, etc. So I've touched on the vector candle, how to sort of use it. It's a very good example there. We get this very aggressive reaction, confirming that we are rejecting this high time frame liquidity point. Money's been taken. We're now looking to reject and take that money from this high back to the bottom side. So now we've took out sellers above this liquidity high. Took out the sellers above this liquidity high up here. We're now looking to transfer the liquidity from them sellers and use it to attack the buyers, which we then aggressively push down, liquidate lows, and eventually liquidate our higher time frame equal low sell side liquidity target, etc. So here's another example where we have the AMD, the accumulation, the manipulation, the distribution of orders. We build liquidity on both sides of the market. Liquidity is being built on both sides. One side gets liquidated. An aggressive move into our high time frame liquidity signifies an aggressive move out. This leaves behind a smart money trap. So we know there's a lot of liquidity resting underneath this high momentum candle. So that gives us good sort of confirmation for a sell. We know we've got liquidity to target. We have our aggressive reaction confirming the strength of this level. We build trend line liquidity, so we've got even more trapping. It's very essential to, when it's the market, sort of build liquidity and have target liquidity. You want to be getting in, anticipating a run on liquidity. We see this final sweep of the last sellers in this supply zone above this high. Once we have this sweep, which is essentially a lower time frame sweep of inducement. So you can see by price here, we've pulled into this level up here. we've reacted off, we've came in, we've formed a high, we've pushed down again here, we've staggered back, and we've came and swept. So it's literally lower time frame inducement, which is one of our entry models, but we're going to talk about that later. It's where we can position ourselves for a sell to come target liquidity levels and higher time frame liquidity to TP at. Lovely. So we've touched on the vector candle, touched on small army trap, touched a bit on liquidity, tiny bit on entries, a bit on the liquidity cycle. We've touched a bunch of things there. Some gems in there. So make sure you definitely study, make notes, go back, rewatch all of this. If you don't, then you're stupid. You should do, because this recording is just me for hours talking. Here's a more lower time frame model. The vector push in, 2 push mitigation, lower time frame liquidity sweep, etc. We're gonna get onto all this. I need to stop getting carried away and talk about entries. We'll save all the juicy bits for later. We're gonna look at something slightly different currently. Going to take a look at the fixed range volume tool, which is just a sort of a trader view tool which you can use to sort of justify your levels a bit more. It's quite a interesting tool. I'm just going to quickly cover it. It's definitely something that can help you sort of train your eyes to spot the more important liquidity areas. So this is just a sell which I took today. We're just going to talk about how the fixed range volume tool can be used in this situation. So let's bar replay this back. Just back to here. Get rid of this. So you'll find it on TraderView. In here we've got a fixed range volume profile, and you want to use it by drawing it from the high to the low of your dealing range. So this high to this low. Identify your next higher time frame drawn liquidity. For me, it's this low here. So I'm looking for sells, and obviously the first low to go would be the low of the range. Looking to sell this zone. When we look at this volume profile, these bars will signify the magnitude of volume, or in other words, orders, which are sort of resting in an area. You can see that at this particular area, there's a high amount of volume. Obviously, this corresponds to this order block here. And we can see that, there's a bunch of equal highs here. So since there's a high volume of orders sitting here because of this level, we know that this is likely to get liquidated. And an interesting thing to note is you can see how in between here we have sort of high volume, and then we have quite a significantly lower volume area here. So essentially between here, between this level here, this line here, and within here, we've technically got like an imbalance between volume. You can see that here. You can see the imbalance in volume which exists here. So you can see that we've got a large large block of orders inside of here, which obviously corresponds to this order block, and then we've got a gap here. So price is likely to want to come sort of liquidate this liquidity in this volume range and come into this area, which is sort of an imbalance in volume, which obviously you can see this was like one of my first sell positions. The prior day was in here, and price came up the day after, and come and swept out this internal range liquidity high. So just like we were discussing previously, internal range liquidity came to sweep this level,